Okay, Chapter 7, Accounting Information System. It's very straightforward chapter. There's nothing hidden. There's nothing scary here. Now, in order we as an accountant or you as a manager to have information about all the accounting transactions, events, and everything that happen, we have to build up effective accounting system. What's an effective accounting system? Effective accounting system is the system that gives you control over the information. You can compare the information from one year to another year or one period to another period. Give you the flexibility. We're going to see one after another. What's that? Prepare reports, which meets your needs, not reports where the accounting system wants to give you, and then you're wondering what kind of report is this and for what should I use this report? And this is not the report that I want. On the contrary, the accounting information system should be able to generate the reports that you need. And obviously, the last thing for that accounting system is you to decide and choose between cost and the benefits of that accounting system. So let's start first, control. What's control? Obviously, the owner of the company and the managers of the company, which manage the company, they must have control. And they have to control the business. Internal control is part of that process of control of the business. Internal controls, those are methods and procedures which are used for the accounting information system in order that accounting information system to somebody to record the right transaction, the accounting information system to provide the right reports, and the owners and the managers actually to get maximum benefits from that system. So internal controls, those are used to first to authorize transactions. Somebody has to authorize the transaction before the transaction is posted. So all those journal entries that we do in debit and credit in the real world, if you want to have proper control over the system, you have to implement authorization process. Second, you have to ensure that adherence of management policy. They have to be extended in management policy who approve the transaction, who posting the transaction, who entering the transaction, who posting the transaction, who's checking the information. Also, you have to safeguard the assets and the records. Assets will be the information, records also all the information which is entered on one place in order to provide the reports. Then you have to be able, that system have to be able to give you opportunity to prevent and detect errors and frauds if those will happen. Through the internal control, you proactively is going to look for the detect and prevent the errors. Then internal control is going to give you the security of limited access to the information to certain people. You don't want all of the people in the company to have access to the records and to the information and to print whatever they want from the accounting system. The last thing is to ensure that the information produced is relevant, accurate, and on time. Futures. What kind of futures that? So for the business transaction, like a selling of inventory, activities related to internal control will be received to customers order. Those are examples of procedures which are implemented by the internal control or the internal auditor in the company to make sure that system provide authorization transaction, all the management policy are followed, the assets are safeguarded, there's no errors and no fraud, limited access to the assets and the records, and information provided relevant, inaccurate, and timely information. Then for the next piece of transaction, purchase of goods or services, then we're going to have this request for the purchase order, approval to vendors, receipt of the goods and services, processing the vendor invoices, and the payments of goods and services. For the payroll, again, there's different steps that we have to follow in order to record all the transactions, prepare the proper reports, and provide the proper information for decision makers. Question for you. Do you want me to give you the actual example in the company of the process of purchasing of goods or services? If you're okay, then I'm gonna move on. If you want me to give you the specific example, I can go for it. You cannot see my screen? Can you guys see my screen with the
Yes.
PowerPoints?
Well,
Yes.
Yes, sir.
Okay.
Yes, sir.
So do you want me to go over the
I think for me,
process,
yes.
or you're familiar with the
If
process?
you can,
Okay, yeah, of course I can. So watch this. For when we're purchasing the goods, let's pretend that we're a merchandising company. We have to purchase. First, we have to purchase inventory in order to sell the inventory. Let's start with the purchasing. First, we're gonna figure out what we want to purchase. Then we're gonna create a purchase order, which purchase order will gonna be approved by the manager. Then we're gonna place that purchase order to our supplier. We're going to send that purchase order to the supplier. On the purchase order is going to have the items and the prices which we already have from the supplier. That's the starting point. After that, when the purchase order is approved and sent to the supplier, then the goods going to come. When goods come, that will be with delivery receipt or delivery documents, shipping documents, and the purchase order. Then we're going to compare what's on the purchase order and what's in the box that just came, or are all the goods or all the inventory that we purchase has been shipped. Is there any back orders or anything like that on the from the purchase order? After that, the invoice is going to come. On the invoice, we're going to make sure that the quantities are correct, the amounts per items are correct, and the total is correct. Now, in the meantime, if there's a broken items, if anything like that, we're gonna send them back by issuing a debit memo to the supplier. Once everything is in order, then we can pay the invoice and the whole process is closed. Now, when we're selling the inventory that we just purchased, everything starts with the sales order. So first, some phone's gonna ring. Probably the sales department, the phone's gonna ring. There'll be customer on the other side. That customer is gonna say, "Can I purchase this and this and this item?" And you're gonna start working on the sales order. That will be the first step. Second step, if the client pay right away, no problem. If the client pay cash or at this time purchase, that's perfect. But sometimes the client wants to pay to open an account. For that reason, you have to have approval for that credit. Then you're going to check once you have the sales order, then you're going to check the availability of the inventory. Do I have enough items of the items that the customer just ordered? If there's enough items, everything is good. Okay. If there's not enough items, the items that you're missing, you're going to create a back order for those ones. And you're going to send it back order to the customer. So they know that the item that you're sending, which you have, there's an item that you're not sending, and those items going to arrive later when you have them available. Then you're going to prepare the shipment. Then you're going to ship the items with the invoice to the customer. Then you're going to process the sales invoice in your records, and the last thing is waiting for the client to pay the money, or you start chasing the client for payment. We're going to see this in chapter 9, how we deal with accounts receivables. For the payroll, the things are very straightforward. First, you have to once you get the new employee, you're looking for approval. It's who manager approved hiring of that employee. After you find that information, usually there should be a contract signed by the owner or signed by a manager. Once you have that information of the contract, then you start collecting information about the new employee, as a SIN number, date of birth, all the other personal information, which information by the Canada Code of Confidentiality, there's a code. That's a confidential information. So very few people should have access to that confidential information, including because that's a very sensitive information of clients, the new employee full name, date of birth, social insurance number, address. You can even ask for the medical health care number, all that information. Then you're gonna once you have that information entered in the system, you're gonna start preparation and payment of the payroll. Obviously, before you do that, you have to collect the time records for that employee. How many hours work per day? How many hours work per week? Who, on which projects or on what kind of activity was involved during that week, or what the employee worked? Who approved that timesheets? And then you can enter it in the system and pay the employee. The last thing is that at the end of the year, you have to prepare reports like a T4 for the employee. That's the process for uh, purchasing the inventory, selling inventory, and the payroll, also the business transaction, normal business transaction in every company that happen. Now let's move to the next thing based on the Internet Control. That will be the information has to be comparable. In order that the system has to work smoothly with the business operations, personal and organization structure. Flexible means that organization, once the organization start evolve, that information system should give you the flexibility to take the new transactions or to change with the changing of the business. Not to be starting accounting information system, but to be flexible in order to accommodate any changes in the business or any changes of any company structure, employees, clients, and vendors. Reports that system provides to the managers and the owners should be what those people need. And the cost benefit analysis, you always have to consider that. What's the benefits that you're getting from the system versus the cost of the system? And if the cost is more than the benefits, obviously you should think about another accounting information system. Now, the component of the computerized accounting system is we have the hardware, which is the electronic equipment. That's a form of computer system and the network links between the computers. We have a network system. And we have a software, which is the system of the programs that drive the computer and perform the works that we desire to be completed. That's why we enter in the software is where we enter in the transactions. Now we can have a cloud computing computing pays to the third-party stored business information, and that's where we're running the information, share information with the vendors or share information with the clients on the clouds. Now it's very popular. Everybody, the vendor and the customers and the vendors to share the information about the client, share information about the transactions, so everybody knows what they have to pay and how much they have to receive. People who operate the system, they have to be properly tracked, and they have to have a proper authorization for all the transactions that they have, that they can enter, and the information that they can have access to. Now, the next objective today is to explain the element of that computerized and manual accounting system and how exactly this system works. Obviously, once the system exists, once we have the hardware and the software and the people, we need to input the information in the system. Then the system is going to do the process of analyzing the data, selecting the data for the reports, and the last thing is the outputting from the reports. Input again is coming from the source documents, which will be the invoice, credit notes, debit memo, uh, payroll records, timesheets, all those different banks deposit slips, everything. Those are the inputs that we're using to input the information, to enter the information in the system. Processing in the manual system, the processing including journalizing, posting, preparing the financial statements. Now in the computerized system, we only doing the data entry. Even the data entry on the computerized system can be set up to be automatically, so we don't have to worry about it. All the information is there as soon as we scan the invoice. The system read the invoice, enter the information, posting the transactions, prepare the records. Outputs are the reports, which are used for decision making. Those can include the financial statements, any other information, any other reports which are related to the business and to the needs of the owner of the business and the management of the business. How are we going to design that accounting system? First, we're going to start with the chart of accounts. That's why one of the first things that I did to you is to give you the chart of accounts. The chart of accounts is give you the map how you're going to enter information into that system. Which part you're going to use. And as we said when the chart of accounts, remember, number one, every account that starts with number one is an asset. Every account that starts with number two is a liability. Every account that starts with number three is equity. Every account that starts with number four, it's a revenue. 5, 6, 7, 8 is reserved for expenses. So this is the structure of computerized accounts. If we can break it simply in the chart. So, as we said, assets start with number 1. When start for the current assets, we can choose 1, 1. So the account here can be, if the account is 1150001, that means first 1 means that's first one is for the asset, second one is for the current asset, fifth 5 is for accounts receivables, 0001 is for the first customer. Following that pattern, the maximum number of customers that this company can have, or before they change the setting, is 9,999 clients or customers. Once they reach 9,999, they have to add another zero here in this number in order to accommodate more clients or more customers. For that reason, it's very important when you're setting originally the system at the very beginning, to think about the future, not just set up the accounts and say my job is done. No, it's not. You have to predict what's going to happen, and you have to proactively thinking what may happen in order to accommodate those future events. So later on, you don't have to make adjustments or start from scratch or changing entire system. Why? Because you just didn't think of something. So you have to be creative here. Obviously, the creation will come with experience. The two options here: either you proactively looking and searching and then implementing what you learn, either you get somebody who actually knows what he's doing and he helps you to set up the accounting system the proper way so you can use it many years after the starting point. So as you can see, again, assets 1, current assets 1. If it's property, 1, equipment 1.5. 1 is for the asset, 5 is for the property equipment. Then we can have 0001, and that can be computers. 002 can be machinery. 003 can be land, or opposite way. Depends what your objective is. In the current assets, we're listing them based on the liquidity. First comes cash, and after that accounts receivables. Then comes the inventory, which inventory is less liquid. For the inventory, if it starts with 1 for the assets, 2 for the inventory, then 0, the next thing that we're going to see here will be 0001. Let's say if we are running a coffee shop, the inventory can be coffee Arabica. Second will be coffee Colombia, or third one can be some other coffee. All the different flavors and types of coffee that we might or you might carry in your inventory. How are we going to process the information? The processing transaction in menu-driven accounting system. In the manual system, credit sales, purchasing account, cash receipts, and cash payments are treated as 4 separate categories. So, we're going to have a sales journal. In the sales journal, we're going to record only and only credit sales. Means that sales that we do on account for our customers. Cash receipt journal is going to record the cash which we're receiving, or when we receive the cash related to cash receipts. Purchase journal, which is going to be, we're going to record anything related to the credit purchases. Means that everything that we purchasing and not paying at the time. Cash payment journal is going to record all the payments that we're making for the purchases related to our credit purchases. And the last thing will be all other transactions which are not part of the sales journal, cash receipt journal, purchase journal, and cash payment journal. I saw one interesting graphic. Let me see if I can see this graphic here. Let me fast forward. So you can see it right here. Yes, there is the graphic. How to choose the proper journal? Since we have a sales journal, we have a sales journal, we have a cash receipt journal, we have a purchase journal, we have a cash payment journal, and we have a general journal. how to choose to which journal you should post the transaction. Very simple. Take a look at this chart. There's activity for you that's going to happen on the assignment and on the exam, on the final exam. So for that activity, please use this chart. How this works. First, does the transaction involve cash? If the answer is yes, then the next question is, did the company receive cash? If the answer is yes, then record it in the cash receipt journal. If the answer is no, then record it in the cash payment journal. Let's test all this chart and see what we can get. Let's imagine that we purchase inventory on account. We purchase inventory on account. Does the transaction involve cash? We purchase in inventory. Is the cash involved? No, not at this point. We just purchase in inventory. We're not paying for the inventory. We just purchase in inventory. So is the cash involved? No, it's not. Is the transaction a sales on account? No, it's purchase on account. No, it's not. If it's not, if the transaction purchase on account, yes, it is. Then record it in the purchase journal. If the transaction was not related to the purchase account, then record it in general journal. Next time when we see each other, we're going to give you, we're going to practice a few exercises, and we're going to use this chart. Actually, we're going to use this chart. Probably I'm going to print this chart for you, and we're going to have it available, and we can go over this chart. So that's going to help you for your assignment, and that's going to help you for your final exam. So let's continue with this. When we're going to enter, when we're going to see the sales journal, cash receipt journal, purchase journal, cash payment journal, and general journal, we're going to see it in this enterprise resource planning system. This is very complicated system. It sounds like scary. In general, it's not that scary. All the systems are just system. Like same thing like artificial intelligence. It's just system. It's created by people to help people. Now, enterprise resource planning system is such as SAP or Oracle or PeopleSoft can integrate all the information of the company into a single data warehouse. On one place, you can find all the information related to the employee, managers, employers, purchases, credits, sales, returns, everything. Feeds that information is going to feed accounting and other data into the software for all companies' activities. What's the advantages? Well, saves money, obviously. Help to adjust to changes and replace the separate software systems. So if you're currently using 2, 3 systems to record on one system, you're recording the purchases, on the second system, you're recording the sales, and the fourth system, you're recording the cash which is received. Here, you can in one system, you have all those different activities tracked, and information can be stored on one single place. The only thing that we have to do is to extract the information in the form of the report. That's going to help you to understand what's happening in the company and then make a decision for the future. At the end of the day, the accounting software or enterprise resource planning system should be able to help you to improve your business, not to make your business more difficult. Journalizing and posting the transactions. Let's see how we're going to do that. Now, we're going to have again special journals in the manual system. Special journal is defined as accounting journal designed to record one specific type of transactions. It only designed to record one specific type. Most transactions fall in one of the 5 categories. First, sales on account goes to the sales journal. If we have a cash receipt, that goes to the cash receipt journal. Purchase on account goes to the purchase journal. Cash payment goes to cash payment journal. Anything else goes to the general journal. That's the general rule. So, how are we going to do with the accounting system? With the special journals for the merchandising business. First, let's go with the bank deposit. Bank deposit, that means we receive cash. That means we're going to record it in the cash receipt journal. Cash receipt journal, if it's related to accounts receivables, it's going to go to the cash receipt journal. If it's not, and one side goes to the accounts receivable ledger and the other goes to the general ledger. From the general ledger, it's going to go to the financial statements and for any other reports which is related. Sales invoice, if we have a sales invoice, that's going to go to the sales journal. From the sales journal, it's going to go to accounts receivable, inventory, because we have to reduce the inventory once we sell it, and to the general journal to keep track of all the transactions. And then we can prepare the financial statements and any other reports. Purchase journal, the same logic. And for the employee time sheets, that's going to go with the payroll journal, which payroll journal go to the general ledger, and from there, from that ledger, we can extract the reports. Let's see what the sales journal is going to do. Sales journal is going to record the sales of inventory on account by creating automatic credits to sales. So once we create that transaction, once we sell something, the software automatically credits sales. What we have to do is to debit the right account. What will be the right account? The right customer's account. To whom we're selling and what we sell. So, posting ledger. Once we post it into the ledger, what's going to happen is we're going to have accounts receivables by clients. Let me make it bigger for you so you can see it. We're going to have these accounts receivables by clients. One client, second client, third client, fourth client. When we combine all the cells, that cell should be equal to the total of accounts receivables that's sitting in our general ledger or as part of the chart of accounts. So in general ledger, we're going to see that our accounts receivables are $4,319. And that's $4,390 come from 1, 2, 3 clients. When we combine 4 clients, when we combine all those numbers, should give us this number. Sales are directly the same number. Why? Because sales is automatically credited. Sales are automatically credited. For the inventory, here we have to reduce the inventory and we have to increase cost of goods sold. On the subsidiary ledger, which will be the subsidiary, it's a file or book of every individual account that make it to the general ledger account. So in this case, this will be your subsidiary ledger, which give you additional information from where the accounts receivables comes from. Where in the general ledger, you're going to see only one amount of accounts receivables. So once you see one amount of accounts receivables, you won't be able to say who owes you money. But once you go to one level down on the subsidiary ledger, you can take a look whose client, when the purchase was made, how much was debited to his account, how much he owes you. Now, this one is often used to provide the detail of the individual balances as a customer or supplies customers for accounts receivable, supplies for accounts payable. We need that subsidiary ledger. How are we going to balance the ledgers? Well, again, once we combine all the subsidiary accounts, the total should be equal to the general ledger account. Now the cash receipt journal, how that works. Cash receipt journal automatically, but we're gonna journalize all the cash receipts. And the system's gonna help us by debiting everything directly to cash. What we have to do, we have to credit something. What we're gonna create? The subledger account for accounts receivables. That's what we have to do. Who client pay us, how much he paid. So it's gonna look something like this. Once we start posting the cash that we receive, we're gonna see that cash received is 6,134, which coming from all those clients that they pay. So once one client pays, that closing his account. So the first client pay exactly the balance that he owes, so that his balance now is zero. Second client didn't pay the whole balance, only $300, and so forth and so forth. And we can see how this balance in cash came from. Well, in this case, came because we have accounts receivables from 1,335. I'm not sure if you can see it, but that's exactly what it says here. Second thing is that sales is related to inventory. Also, not payable. We pay something on the not payable or borrow money here if it's on credit. And then we have a sales revenue, which is related to our sales. Then we having the sales discounts, and we have the interest revenue, which we receive interest, and the cost of goods sold. That's related to our inventory and how we did our sales and the sales. As you already know, once we do the sales in the perpetual system, we have to do transactions for the cost of goods sold. So that's all the information is recorded in our accounting software. It's tracked by the general ledger, cash, accounts receivables, inventory, and all those accounts, cash, accounts receivable, accounts payables, they have subledgers, which shows you detailed explanation from where the amount on the general ledger came from. Now, the next thing that we have to do is to actually explain for you how we journalize and posting transactions using the purchase journal and cash payment journal and accounts payable subsidiary ledgers. Purchase journal, same like a sales journal, is designed to account for all the purchases of inventory, supplies, services, and other assets on account. So everything that we purchasing go through the purchase journal. Purchase journal itself posting from the sales and the cash receipt journal to the general ledger, which is general ledger that will be accounts payable. Let's see what's going to happen. We have the purchase journal, and I'm going to make it a little bigger so you can see what's happening here. We're going to have accounts payable on the credit side, so we have to debit something. But when we purchase inventory, we're going to debit the inventory, and we're going to create the accounts payable. When we purchase supplies, we're going to debit supplies, and the system automatically is going to create accounts payable. When we purchase the furnitures, we're going to debit the furnitures, and the system automatically is going to post it to the accounts payables. When we purchase the equipment, we're going to debit the equipment, and the purchase automatically is going to post the credit to accounts payable. And then we're going to see that accounts payable, general ledger, have this balance, $2,876, which that balance comes from all those single accounts. And now we can see to which vendor we actually owe money. As you can see here, the account number starts with 2. That means 2 is a liability. 1 is current liability, and then based on the structure that we have in the accounts, every single numbers can be exactly those. Now the cash payment journal. Now the most cash payment journal are made by check, and they're recorded in the cash payment journal. So this is a very common form of payment by check. Now after the COVID and after the coronavirus reality, now we have a new payments which are very popular, which is electronic fund transfer, or we may have e-transfer, or we may have a direct deposit. All those are different by meaning and different by the nature of the transaction. For electronic fund transfer, if, for example, you need the bank account of the vendor or the supplier to whom you pay. When you're using the e-transfer, you don't need a bank account. You only need email or cell phone number. So the nature in both cases, you pay cash, but the nature of the payment is different, or the way how you pay is different. And now this special journal, which is the cash payment journal, also can be called cash register or cash disbursement journal. What's going to be interesting in that thing, every time when you write the check, you're going to have the following columns: date, check number, PE, accounts, which is debit. No, that will be the cash payment journal. On the cash payment journal, actually, you're going to have date, check number, PE, account, which is debited, which vendor you pay, cash amount that will be automatically credited to cash, and description and amount of other debits and credits if there. So what's going to happen is, in general, the cash going to go down, and accounts payable is going to also go down. And that's how we're going to link those one. Let's see here the example. Now accounts payables, once you debit the accounts payable with the amount, your cash is going to go down with the same amount until you eliminate the balance and bring the balance to zero on accounts payable. And obviously that's going to affect your cash balance. So the next thing is to journalize and post entries not recorded on the special journals, which is the sales, purchase, cash receipts, cash payment journal. If there's nothing belongs to those four, nothing related directly to sales or cash receipts, nothing related to the purchase and payments and purchases on account, then we're going to go directly to the general journal. In the general journal, that's a special journal which saves much time in recording a repetitive transaction and posting to the ledger. Well, some of those transactions they don't fit sales, purchases, cash receipts, cash payments. Each accounting system, obviously, you're going to need that the general journal in order to journalize the transactions which don't belong to those four categories. What entries are recorded in a general journal? Well, that will be merchandise return and allowances, adjustments such as amortization of building equipment, expiration of prepaid expenses, and accrual of the salary payable at the end of the period. Those are just examples that may be recorded. If you have interest on the bank account, again, you're going to use the general journal. If you have expenses which are not directly involved with the purchases, you can use the general journal. There are so many reasons to use the general journal. And again, we come into the chart. Let's see something. Merchandise return and allowances. Let's pretend that we purchase the inventory with the purchase order. The inventory, the shipment came. The purchase order was in the box. We checked the items and we saw three items broken. Now what we have to do, we have to issue the debit memo, put it on the separate box, send it back to the vendor, which with request of on return in this case. So we have the inventory, returning the inventory. So let's follow this. We return the inventory. Does the transaction involve cash? Well, we're returning the inventory, so that means the answer is no. Does the transaction is the transaction sales on account? No, it's not. We return the inventory. Is the transaction a purchase on account? No, it's not. We return the inventory. So what we have to record it in the general chart. That's why this chart is very powerful. I want you to work with it and play a little bit with it so you get the idea of how exactly you can use it to answer the questions which are sitting for you. The last learning objective is to use the special journal to record the post-transaction with the sales taxes. I'm not going to torture the sales taxes with the GST and HST. There are always going to be sales taxes for the GST and HST. The tricky part with the GST, for those of you who continue with accounting, or this is the first part of the accounting, but yeah, you have to continue with the accounting in order to see the second part on the GST and PST. Then those things are going to be discussed with you. Now, one thing that I wanted to show you is example of, I have here pictures of accounting system, accounting software. This accounting software is from the old Simply accounting system. I cannot give you anything new because that will be a little bit too stretch. But let's take a look of this picture that I have here prepared for you. So this is the how the interface or the screen for when you enter the Simply accounting would look like. So you're going to have on the top different ledgers that you can use to enter the transactions. So for the vendor and the purchases, you're going to have this purchase ledger. For the sales, you're going to have this customer sales ledger. For the payroll, you're going to have this payroll ledger. For the inventory, when you purchase the inventory, when you're selling the inventory, you can have this inventory. And this is this ledger here. That will be the for the if you have a project separate, so many works, and every work is requires separate project. You can use the projects. This is on the level of the ledgers, and of course, in the beginning, you're going to have this general journal, which you recording all the transactions which are not related to sales, purchases, payroll, inventory services, and projects, in this case. Now, later, on the second level, you're going to have the purchase orders and quotes. Remember this. Then you're going to have sales orders and quotes on the customers. You're going to have a paycheck for the employee. And you're going to have items assembly for the inventory and services. For the bank, you're going to have all the information about different bank accounts. When you combine all the bank accounts, that's going to give you the total cash. Payments. Now we go into the next journal. So you can see we have a general ledger. You can have purchase, general journal, purchase journal. Then you have a payment journal. You have a customer journal. Then you have receipt journal. Those will be the five main journals. Those are the five main journals in every accounting software. That was Simply Accounting. This is another look at the Simply Accounting. As you can see, let's see, this is related to the sales and what exactly happened with sales. First, we're going to have sales order or sales quote. Well, the client called you, you accept, then now you start the service order. You may have a service quote. Then once the order is completed, when the goods are sent to the client, then you can invoice the client. And the client received the goods in good condition and he is agreeable term of the receiving, you can create this sales invoice. Enter the sales invoice and then waiting for the payment and through the receipt journal to enter the payment to that invoice. And apply the payment to that invoice so you can clear the invoice. Once you clear the invoice, that's going to reduce the customer's balance as well. So this is another thing. That's a customers. You have again sales order. Then you prepare the estimates. Then you create the invoice. Then you ship the items, and then you can prepare the statements for the outstanding amounts through the accounts receivables payments. So you're gonna once you have the create invoice, you're gonna create an account for that customer. And then every time when the customer pays, you can create a sales receipt journal and track of what the customer pays on each level and what's the current balance for that particular customer. Those are the examples that I prepared for you. So the most important thing is you to understand which transaction to which journal belongs. And the easiest way, again, is by using this chart from the PowerPoint. Let me show it with you. This chart is the easiest way you to identify which journal the transaction belongs and why do you have to put it there. And that concludes the chapter 7. So this is the example of the question that you can see for chapter 7. Those are the transactions. For each of those transactions, I want we to identify to which journal should be recorded. We can use the following: J for general journal, P for purchase journal, S for sales journal, CP for cash payment journal, and CR for cash receipt journal. So let's see first one. cash sales of inventory. If we have cash sales of inventory, let's go to the chart, or maybe I should get this chart and post it at the end of the Word document right here. So once we have this chart, we can easily start working. Cash sales of inventory. Is cash involved? Yes, it is involved. Does the company receive cash?
Yes.
Yes. If it says recorded in cash receipt journal. Next transaction. Payment of rent. Is the cash involved?
Yes.
Yes. Did the company receive cash?
No.
No. Then we're going to record it in the payment journal. Next transaction. Amortization of computer equipment. Is the cash involved?
Yes.
Yes.
Amortization of computer equipment. What will be the transaction? Debit accumulated amortization, debit amortization expense, credit accumulated amortization. Now the question is the cash involved? Did we debit cash? Did we credit cash? If our transaction is debit accumulated, amortization expense, credit accumulated amortization, is the cash involved now? Obviously not, right? Is a transaction sales on account? No, it's not. It's amortization. Is a transaction purchase on account? No, it's not. It's amortization. So which journal we're going to use?
General.
Next one. Purchase of inventory on account. Is the cash involved?
No.
No. Is a transaction sales on account?
No.
No. Is the transaction purchase on account?
Yes.
Record it in the purchase journal. Make sense?
Yes.
That's what I want you to do for the rest. Practice those one. I'm going to give you the answers next time in class. Go over this, and you're going to have assignment questions like this. The other assignment question that you might see is that the calculation of the general ledger amount based on the subledger accounts. All the subledger accounts, when you calculate them together, is going to give you the total is going to be the general ledger amount. That's for the accounts receivable. So accounts receivable amount that you're seeing on the general ledger, that comes from the subledger accounts for all the accounts receivables for every single client that we have in the system or in the accounting software.